Welcome, economic enthusiasts, to Fact Studio. Today, we embark on a compelling exploration into the intricate world of economics and finance. In this series, we'll dissect economic facts and trends that shape the global landscape, starting with an in-depth analysis of key indicators that define the pulse of economies worldwide. Our journey begins with a fundamental metric that serves as the heartbeat of nations: gross domestic product, or GDP. This comprehensive measure encapsulates the total value of all goods and services produced within a country's borders. But what insights can we glean from this numerical representation of economic output? This numerical representation encapsulates the total value of all goods and services produced within a country's borders over a specific period. To truly comprehend the significance of GDP, let's break down its components. First, we have consumer spending, the financial pulse of households. As consumers buy goods and services, it drives economic activity and indicates the overall health of the economy. Next in the equation is business investment. This encompasses spending on capital goods, research, and development. A robust level of business investment indicates confidence in the economy's future, while a decline may signal caution or economic uncertainty. Government spending is another crucial component. As the public sector invests in infrastructure, healthcare, and education, it injects funds into the economy, influencing its overall trajectory. And let's not forget net exports. By subtracting the value of imports from exports, we gauge a nation's trade balance. A positive balance contributes to economic growth, while a negative balance may pose challenges. GDP is not just a number, it's a comprehensive snapshot that policymakers and economists analyze to understand a nation's economic performance. A growing GDP signifies a healthy, expanding economy, while a declining GDP may indicate contraction and economic challenges. It's essential to distinguish between real GDP and nominal GDP. Real GDP accounts for inflation, providing a more accurate reflection of economic growth. Nominal GDP, on the other hand, represents the current market value without adjusting for inflation. By analyzing GDP trends, economists can identify patterns, anticipate economic shifts, and formulate informed policies. However, it's crucial to recognize that GDP has its limitations, such as not accounting for income distribution, environmental factors, or the informal economy. Now, let's delve into the rhythmic heartbeat of economic activity, the business cycle. Picture it as a natural ebb and flow, a recurring pattern that defines the varying stages of economic health and vitality. At the heart of the business cycle are four key phases: expansion, peak, contraction, and trough. Each phase plays a crucial role in shaping economic trends, policy decisions, and the overall well-being of nations. Our journey begins with the expansion phase. Here, economies flourish, businesses thrive, and employment rates rise. Consumers feel optimistic, leading to increased spending and investment. It's a period of economic prosperity and growth. As economic activity reaches its zenith, we enter the peak phase. This is the height of prosperity, characterized by maximum employment, robust consumer spending, and soaring business profits. However, like the climax of any story, the peak phase marks the transition to the inevitable. Following the peak, we encounter the contraction phase. It's a period of economic slowdown, marked by a decrease in business activity and a rise in unemployment. Consumer confidence wanes, leading to reduced spending. Governments and central banks often step in with interventions to mitigate the economic downturn. Yet, from the depths of contraction emerges the trough. This is the lowest point of the business cycle, characterized by high unemployment, decreased production, and economic hardship. However, it's also the starting point for the cycle to begin anew, as economic forces set the stage for recovery and growth. To navigate the business cycle, economists rely on a toolkit of indicators. Leading indicators provide insights into where the economy is headed, lagging indicators confirm trends, and coincident indicators track the current state. By analyzing these markers, economists aim to anticipate shifts in the cycle and inform policy decisions. As we conclude this exploration of the business cycle, it's crucial to recognize that these phases are not linear or predictable. Economic forces are influenced by a myriad of factors, from global events to technological advancements. Join us in future episodes as we unravel more economic intricacies and uncover the trends that shape our financial world. As our exploration of economics and finance continues, we navigate through the relentless forces of inflation and deflation. These economic phenomena wield significant influence over the purchasing power of currencies and the overall stability of economies. First on our agenda is inflation, the steady rise in economies. Inflation erodes the purchasing power of money, affecting consumers and businesses alike. As prices rise, individuals may experience a decrease in the real value of their savings, influencing spending patterns and investment decisions. Economists often measure inflation through indices such as the Consumer Price Index, CPI, or the Producer Price Index, PPI. These indices track the average change over time in the prices paid by consumers or producers for a basket of goods and services. Now, let's pivot to the counterpart, deflation. This is the decrease in the general price level of goods and services, often associated with economic contractions. While falling prices may seem favorable at first, persistent deflation can lead to a vicious cycle of reduced spending and investment. Deflation can be particularly challenging for debtors, as the real value of debts rises in a deflationary environment. Businesses may delay investments, and consumers may postpone purchases, contributing to economic stagnation. It's essential to note that a delicate balance is required. Central banks aim to maintain stable prices by targeting a moderate level of inflation. This allows for a healthy level of economic growth while preventing the adverse effects of deflation. Extreme cases like hyperinflation, where prices skyrocket uncontrollably, and stagflation, a rare combination of high inflation and stagnant economic growth, underscore the importance of balanced economic policies. As we conclude our exploration of inflation and deflation, it's evident that these economic forces are intricate and multifaceted. As we continue our exploration into the realms of economics and finance, our gaze shifts towards a critical aspect of economic well-being, unemployment rates. These rates are not just statistical figures, they embody the livelihoods and societal health of nations. As we conclude this introduction, we've merely scratched the surface of economic facts and trends. The economic landscape is vast, evolving, and interconnected. Join us in the upcoming episodes as we navigate through data, trends, and stories that unravel the mysteries of economics and finance. Thank you for embarking on this intellectual journey with us. Stay curious, stay informed, and stay tuned for more insights into the fascinating world of economics and finance. Until next time, this is Fact Studio, guiding you through the intricate web of economic complexities.